Hi friends, welcome to my YouTube channel Ask Investment Academy. Today we are going to learn about what are the different taxes levied on stock market gains, and we will also learn about what advantages we will get by filing losses in every year's ITR. So first try to understand what are the different types of taxes levied. Taxes are broadly divided into two types. First one is taxes on investment income. Second one is taxes on trading income. I will cover taxes on investment income in this video, and in my next video I will cover taxes on trading income. Investment incomes are broadly divided into two types. First one is long-term capital gains and second one is short-term capital gains. First, try to understand what is long-term capital gain. The realized gains from stocks or equity mutual funds by holding for more than 1 year is called as long-term capital gain. So taxes levied on long-term capital gains is called as long-term capital gains tax. Simply LTCG tax. Now try to understand what is STCG. Realized gains from stocks or mutual funds by holding less than 1 year is called as short-term capital gains, and taxes levied on short-term capital gains is called as STCG tax. Okay, these are investment taxes. Now try to understand what are the taxes on the trading income. Intraday profits are called as speculative income, and profits from futures and options are called as non-speculative income. We'll discuss in detail about the taxes on these incomes in my next video. Now try to understand what is LTCG and STCG in depth. LTCG tax has to be paid for realized gains for stocks or equity mutual funds booked after holding for more than 1 year. In this case, you will get tax exemption for first 1 lakh rupees profit, and 10% tax will be levied for additional profits. Now try to understand what is STCG tax. STCG tax has to be paid for realized gains for stocks or equity mutual funds booked after holding for less than 1 year. In this case, you will not get any tax exemption, and a flat 15% tax has to be paid for entire profits. Now, let us take an example of LTCG tax. If you have bought 1000 shares of Reliance at 2000 rupees per share, and if you have booked profit after 1 year at 2400 rupees per share, your total profit will be 4 lakh rupees. Since you will get tax exemption for first 1 lakh rupees, your taxable gain will be 3 lakhs. So you have to pay 10% of your taxable gain, that is 30,000 you have to pay as LTCG tax. Now try to understand what is an STCG tax. So we'll take one relevant example here. If you have bought 1000 shares of Reliance at 2000 rupees per share, and if you have booked profit within 1 year at 2400 rupees per share, now your total profit will be 4 lakh rupees. Since this is a STCG gain, you will not get any tax exemption. You have to pay flat 15% of tax for your entire profit. So 15% of your 4 lakhs will be 60,000 rupees. So your STCG tax will be 60,000 rupees. If we file LTCG losses and STCG losses in ITR, they can be carry forwarded for next 8 years. That means you no need to pay taxes for next 8 years profits. Present year long-term capital losses can be compensated with next 8 years long-term capital gains. Present year's short-term capital loss can be compensated with not only STCG gains but also your LTCG gains for next 8 years. So always file ITR for both profits and losses in the stock market. Filing profits is beneficial for government as it will get money for the government from us. Filing losses is beneficial for investors as they can save money in future from paying more taxes. In my next video, I will cover about taxes on the trading income and benefits of filing trading losses. If you find this video useful, please like, share and subscribe to our YouTube channel for more videos on the stock market.